A rally for Under Armour today. Raymond James out with a bullish new note, upgrading the stock to a strong buy from Outperform. The firm saying they have become more comfortable with the company's risk-return profile. This is our call of the day. The question is, do you buy into this call, Weiss?
No, absolutely not. It's still, talk about overvalued, companies selling at a premium to the market, Boeing or Under Armour. To me, it's still egregiously overvalued. What are you getting? You don't even know what the accounting scandal is. There's been a management change. The culture's been terrible. And guess what? You've got a very crowded athletic wear market. So no, I wouldn't buy it. I don't know what the fascination with this small cap stock is. I mean, it's ridiculous. I'd rather short it than buy it. But of course,
you're on the same page on this one.
Only half.
Oh, okay.
I'm not short
it because I can't possibly agree completely.
I'm not short because you're not shorting any stock in this market. But no.
So here's
Does that answer your question, Mel?
Yes.
So I liked this report. Of course I can't buy Under Armour, right? The market multiple is egregious. The multiple is egregious. There's not enough free cash flow yield for our growth strategy. There's not enough dividend yield for our dividend strategy. But I want to give a shout out to my nephews and my daughter because they own it, and they own it in their little portfolios that they keep. And what I like about this is it reminds you that it's like different strokes for different folks, and different stocks make sense for different people in their portfolios and what they're planning to invest in. So if you want to trade it, maybe it makes sense. The Raymond James report was pretty compelling, and you see what the growth in earnings could be, and that's not something to take lightly when you actually do see the potential growth ahead.
From 2010 until 2016, this company grew revenue at least 20% year on year every single year. In 2017, that fell to 3%. 18, I think they did 4%. 2022, 2023, maybe they'll get close to 10% once again. So is the bottom in for the stock? Possibly, yes. Would I be overly excited about buying it here? No, because there's an alternative, and it's Lululemon, or to another extent, Nike.
And Mel, I think even though they addressed it in the note, they talked about the DOJ investigating them for, maybe manipulating numbers or something. I don't think that's as small a deal. They said, well, we had given it a much larger standing, and now maybe we think that has shrunk down. I don't know what they're basing that on. Just because there's been communication back and forth, they of course have to communicate. I mean, that's part of this whole process. So I wouldn't read into that the deal, that there might be a deal struck and it's going to be a smaller fine or anything else. I would say it's a don't touch until that is more clear exactly what the penalty will be.
And keep in mind, this is a material factor that the company had not disclosed for
years.
That was my issue.
For years.
And so this just doubles down. Now, Kevin Plank was a genius because he built this company, and it's still a multi-billion-dollar company on one hand. On the other hand, maybe since he's left, it'll be better. But to hold that for 2 years, how do you do that? That's shareholder lawsuits right there.
It's a credibility issue.
Right. So move on. There are other stocks to own.
Yeah. Within the world of a strong consumer, Joe, since you're a huge believer.
I'm looking at my picture. They need to change my picture up there.
Why? What's wrong with that? You look nice
the hair looks a lot different.
It's a little higher. It's like an inch high versus.
Well, there's less of it and there's more gray.
Looks like a John Travolta toupee.
I think you look good, but you could have a new picture, I suppose.
Time for a new picture.
Your favorite consumer stock here?
Well, there are retail names that I'm in, and recently I bought Best Buy Store Capital, which is a REIT. I know Josh Brown obviously owns that for quite some time. That's worked well. Walmart has been a favorite name of mine now for the better part of a year and a half. TJX, I bought that recently off of earnings, and Lululemon, we're waiting for their earnings. But as I mentioned before, on the apparel side, that's where you're getting the growth. I know with Best Buy, John and Pete, I know they both disagreed with my buying Best Buy yesterday, but I'm playing for that breakout above 85. I think ultimately you're going to get it. I think there was a lot there in terms of diversifying the business model that was good, getting into healthcare, getting into services, not solely relying on consumer electronics. It looks a lot like Target. Right.
You own L Brands. What do you hope will happen with this one?
I hope it gets sold, quite frankly, Mel. But I think that this was about as bad a slide as almost JCPenney was, except this one has more exposure to the younger market through Pink and their other assets. That I think that's why I own it. I basically bought it when it broke 16. I still own it here as it's between 19 and 20. I haven't looked today.
You like the mall side of the picture.
So interestingly, in our dividend income portfolio, we own Tanger, right, which is the outlet malls, and that has huge moats and safety and 97% occupancy and 27 years straight of increasing the dividend and a fortress of a balance sheet. The Simon Properties, which we own currently in our growth portfolio, we're thinking about removing from our growth portfolio.
Why?
And this goes back, well, because there's just not the growth. The mall traffic decreases at about 7% a year, and we think that that's a real risk to the growth. But this goes back almost jokingly to the Under Armour, different things for different people, right? Or different things for different portfolios. So while we might think about taking it out of our growth portfolio, it could have a very important place in the dividend portfolio. They've actually raised the dividend by annualized 8% over the past 4 years. I think the yield's at about 5.8% right now. And it's a really, really high quality company in the highest quality mall REITs.
You got one lone retail stock in your consumer portfolio, Weiss. Target.
Actually, it's not true. I've got a lot of retail exposure. I own Baba.
That's the only one next to your picture.
Well, that's the conventional
Target.
retail. Think outside the box. Okay, for a bit here.
Out of the big box?
Out of the big box.
It's a big box.
Think out of
Big
the big
lots,
box, out of the
big
ball
box.
box. I do own Target, but I also own Amazon.
Okay.
I own Baba. I own United Airlines. That's consumer. I own Visa. So it depends how you get your exposure. I think in pure retail names, if you're not thinking right now that after Black Friday you're going to hear about how sales were disappointing for the weekend because of all the weather issues, then think again. So if I did own other retail stocks, I'd probably sell some calls, upside calls to it, because that's what the dialogue is going to be. Flights being canceled everywhere, weather rolling through the country, people aren't going to be going out. They'll go to Amazon. But maybe they just don't go to Black Friday sales. So.
Two names I think we should point out. First of all, Buckle, which is now back around $1.3 billion in terms of.
That's a Pete Nigerian name.
It's a Pete Nigerian name. It's a name that the last couple of years has suffered. It's getting a little bit of a bounce. That's more for a trading opportunity, but for an investment, and I definitely missed this one. Burlington Stores. Burlington Stores has just done fantastic trading at 225, and that's been a consistent theme that's defying the overall brick and mortar environment.